All right, this is part 2 of capital structure. So go to the learning activities and grab the capital structure to file here. And when you open it up, I want you to open it up. You right click on it, say show in folder. And when you show it in folder, I'm going to right click it again. And I'm going to go to properties. And I'm going to move this over here to show what it looks like. And on the bottom there it says security. This file came with another computer and might be blocked to help protect this computer. So hit unblock. Hit OK. All right, first thing we're going to do is going to put our name in it. So put your full name, and that's automatically going to open up the question that pops up. And then go to the bottom there. This is part 2, chapter 14. All right, so what I'm going to do here is I'm going to calculate all this stuff. And I'm just going to do this middle one. This is, I'll do the example with 500,000 in debt. The capital structure is 2 million. We have a risk-free rate. We have market return. That's the expected return of EBIT. I got taxes. Unlevered beta. Unlevered beta means beta that doesn't have debt. And so right away, I'm gonna show you real quick. Here's the levered beta. So the part here where it says zero debt, that means we have all equity in our 2 million. That would be that beta. As we increase the debt, and we're going to use that debt to purchase back stock, our beta should change on those. So I'm just going to do the middle one, and then you have to figure out the other ones. So let's do 500,000. So first thing I want to know is what's the debt to capital ratio? So that's just the 500,000 divided by the total capital is debt plus equity. That'd be invested capital. Capital structure right now is 2 million. So we just want to calculate that. That's 25%. As you can see, that would be 50% there. That'd be around 30, whatever, 3. And then we want to know what's the debt to equity ratio. Well, debt plus equity equals capital, and debt divided by capital, excuse me, is right here. So you could find the dollar value. You could do 500,000 divided by, well, what is the remaining equity? If 500,000 is debt, that means 1.5 million is equity. You could do that. I'm gonna do something a little different. I'm gonna divide the percentage, 25% debt, and I need to divide that by how much equity. Well, how much equity is in there? I'm just gonna do the equation 1 minus the debt, right? So debt divided by 1 minus the debt. The 1 minus the debt is the equity. So if you do that, that will be our debt to equity ratio, which is the 33 I was thinking, not this one. So hopefully that makes sense. You could do the dollar value. I find this is easy. So then all you have to do is really you got to drag that down. Drag it up and down. That should calculate it. Next, what we have to do is calculate the levered beta. If you look at the PowerPoint, I believe it's on slide 31. It's called the Hamada equation. It's when you take a unlevered beta and you add some form of debt. We want to see what that would be. I'm gonna see if I got the PowerPoint up. I do got it up. These are kind of the equations that you're not going to memorize, but if I was right, I said 31. Slide 29. The Hamada equation is, so as you see, that's the levered beta is equal to the unlevered beta, which we have. Multiply, you have to do the brackets, 1 plus, and then you want to do 1 minus t divided by the debt to equity ratio. You want to put that all in a bracket. So let's put that together. So is equal, this is the levered beta, what we're trying to calculate. It's equal to the unlevered beta. Now you want to think dollar signs if you want to drag it up or down, right? I want that unlevered beta right there. I want that frozen. So you may want to put a dollar sign there. and that's going to be multiplied. I'm going to put a bracket there, and that's going to be 1 plus, then I'm put another bracket there, and then we're doing 1 minus taxes. Now, why are we doing that? It's because when you increase the debt, there is a benefit to that, which is the tax um, uh, ratio. I'm sorry, it's that you don't pay taxes on your interest. So you see, then you want to close that up. So it's the 1 plus that. So we're right there, and I already closed it up. And then you want to multiply that times the debt to equity ratio. And that is right here. That's our debt to equity ratio. Then I'm going to close it up, and I want that unlevered multiplied by the whole thing. And that gives us, you see that we get an increase in the beta because we increase the debt. You increase the debt, you increase the risk. Next, we want to know, what is the required RS? What's the required return? The required return is for equity. That's RS. That's the cost of equity, you can say, or the required return. And then RDs are the costs of debt. So let's find out. So there's different methods we can use. We've done this all semester. If you notice, it gave us like the beta. That should be a clue what we use. We want to use CAPM. So I'm going to equal, and we got all the variables here that we need. We got the risk-free rate plus the beta multiplied times the premium in the market. Well, it gave us the market return minus, that's the market return, and I'm going to subtract out the risk-free rate. And think about the dollar signs, right? I want to put dollar signs on these two variables. I want to put a dollar sign on the risk-free rate out here, but I want it to change with the beta. So you want to think about how to do that. So that's the return on equity. Next, we want to find out what's the after-tax cost of debt. Well, that's the before-tax cost of debt. So I'm going to take that, and I'm going to multiply it times 1 minus the tax rate. That's the after-tax cost of debt. So we 25% tax rate. Now we got to find out the WACC. So remember what the WACC is. It's a weighted average cost of capital. I have to know the weight of equity. I have to know the weight of debt, which I do know the weight of debt. We already calculated it. It's the first thing we calculated. The weight of debt is 25%. But we don't know equity. I mean, we could figure it out, 75%. But we want to do a number we can drag it. So you want to think about, to solve it really quick. Let's do this first. So WACC is going to be the after-tax cost of debt multiplied times the percent of debt. That's the weight of debt, plus, now I want to get the cost of equity, and I'm going to multiply times the weight of equity. Well, I'm going to do that fun equation again. It's 1 minus debt. Right? 1 minus debt will be the percent of equity. And if you do that, because I selected that debt, if you drag it down, it will do it properly for the next capital structure. So that's our weighted average cost of capital. And I forgot to mention at the beginning, what's the purpose of our capital structure? We're trying to find an optimal capital structure. And you know it's optimal if you maximize WACC. I'm sorry, you minimize WACC, that's the cost, and you maximize the stock price. That's how you know you pick the optimal capital structure that benefits the company. As you see, the shares outstanding shrinks as you get more debt. It makes sense because we issue debt and we purchase back equity. And that's how we change the capital structure. So the next thing I want to know is, what is the earnings per share? Earnings per share. Well, this is directly from the income statement. So we need net income. What is given to us is earnings before interest and taxes. I need earnings after interest and taxes. So I'm going to go equals. I'm going to go to EBIT. Again, think about freezing in what cell. And I'm going to multiply that times. The first thing is the cost of debt. And I'm sorry, I don't want to multiply that. Let's bracket that. I'm trying to think if that would make a mistake there or something. So EBIT, and I want to subtract out the interest payment first. Well, what's the interest payment? Well, I'm not taking the after-tax cost of debt, or I'll be double dipping, because it's important because we take out interest before taxes. So I need the before cost of debt. So I'm going to take the EBIT and I'm going to subtract out the costs of debt times the amount of debt, the 500,000, right? That's my interest payment. I'm paying 9% of that 500,000 per year. So that's going to subtract it out. After we get that number, so in that bracket, that's going to be EBT. That's going to be earnings before taxes. To find earnings or net income or net earnings is I'm going to multiply that, not times the tax rate. That would tell you how much you're paying in taxes. I'm going to multiply it times the bracket. I'm doing 1 minus taxes. Right? Now that's the net income then. And then I'm going to divide that entire thing by earnings. That's in earnings there per share. And there's our shares outstanding. So that's going to be our earnings per share. Next, we want to know dividends per share. So the PowerPoint says the assumption of this business, which I didn't like they made that assumption, was 100% of earnings is paid out as dividends. So reverse back to the beginning of the course that we said there's two things you could do with your earnings. You could pay out the shareholders as dividends, or you could reinvest it back into the company. The assumption the PowerPoint said we're paying 100%, so we're not paying back. There's no dividends. I'm sorry, we're not reinvesting the money at all. We're taking all our earnings and paying out the owners. I don't like that. So what I did was I did a dividend payout rate of 95% and I added this. So earnings per share do not equal dividends per share. In my example, the textbook said it did. I don't like that assumption. So I have to say if this is earnings per share, that means dividends would be 95% of that. So pretty simple. And the last thing is we want to know the price, the stock price. What model are we going to use? Well, we got dividends. So we could do the dividend discount model or the discounted cash flow model. So we're going to do here, there's no growth of the stock or the dividends that we're making assumption, but it is a perpetuity. So we're assuming that the 4.22 is going to go forever. So it's going to be a perpetuity would be the cash flow, the cash payment, $4.22 divided by RS, the return on equity. And we've done that before. So the stock price is $24.98. There you go. So I just want to do that. You can fill in the rest. The only thing I would keep in mind is the WACC at zero debt is just the RS. Just want to put that out there because 100% equity. So whatever the RS, the return on equity is, or the required return on equity, that's going to be our WACC. Once we introduce debt, now we have a different weight of debt and equity, so then you have to do the calculations. There you go. God bless. Any questions, feel free to email me.